on this computer. Okay, perfect. So what we talked about this last week was about the different types of term policies that we design them for protection on mortgage. And we also mentioned like, oh, it's important to kind of partner up with a realtor or a loan officer to write these type of policies. And also when we get to that point that we can buy leads, these are going to be the easiest policies, because a lot of people want to protect their mortgage, or they want to protect their mortgage payments in case something happens to them. But when you talk about life insurance, they don't really like connect the dots. At the end of the day, I was talking last week that if you receive like any type of marketing saying mortgage protection, basically it is life insurance. That's what it is, right? So this reference guide, it's going to help us with all these companies that do term, that are simplified underwriting and not simplified underwriting, to tell us if a client will be approved or not. Like I mentioned last time, simplified underwriting, which means getting approved right on the spot, it doesn't mean that it's going to get approved all the time. It could be declined, right on the spot. So it is going to ask you health questions. Of course, if someone has cancer, they're not going to give them a policy because they already know the risk. So this guide, so for example, if they are in alcohol treatment or advised to limit or discontinue use, here it says the companies that might approve or decline. In this case, the alcohol treatment, DUIs and alcohol issues are very big on declining in life insurance. In life insurance, so all these type of products are going to get declined, right? It says in here. So if the client has one of these, it's going to get declined. So Alzheimer, dementia, it's going to get declined. An amputation, it's going to get declined, not with CFG, which is an option that we have. We don't get appointed with this company unless we have a policy to write with. Why am I showing you this? To show that we're going to have options for every single client. So for example, if you have a client that went through an amputation, we already know that CFG, Safe Shield, it might approve them, okay? Other carriers will decline him. Let's see, bipolar depression, schizophrenia will be declined. Assistance with ADL, CFG with call underwriting. For this one, even National Life Group doesn't approve these disorders as well. Now, this one, cancer, leukemia, melanoma, or any other internal cancer, Americal HMS Plus, if diagnosed and end treatment, it's over 5 years ago, it's okay. Otherwise, it will be declined. So, which means if your client was diagnosed, let's say 6 years ago, and then it's been completely good for 5 years, they end their treatment, they're good, they can get a policy, a term simplified policy with America. The product is called HMS Plus. Not all carriers do this. Once you have cancer, it's very difficult for a carrier to approve a policy. That's why I wanted to show this. Then we have carotid artery surgery, lap band surgery, gastric bypass. CFG will be okay. Foresters will approve it. Term Life Express with MMO will approve it, which is Mutual of Omaha. And Americal HMS, which is funny, you need to call to get underwriting, or it can get declined as well. Weight and height, it's okay. Okay, depending, of course, depending on your weight and height, the pricing can go up because of the risk. It will be declined for chronic kidney disease, chronic lung disease, bronchitis, all this, DUI. Okay, DUIs are big. So CFG will approve or simplify if it's over 3 years. Okay, and it's only one DUI. Now, like for example, National Life Group, they're very, very strict with DUIs. Usually, if it's not over 10 years, usually not all the time, because I've seen some exceptions, they won't approve the policy because they already put you in a high risk. Why? Because if you have a DUI, it means that you heavy on alcohol, which means that you're going to take a lot of risk when it comes to driving, which leads to the percentages of you dying in an accident are higher, right? So just to make sure we have that on the simplified aspect, it will be declined with Foresters, with Mutual of Omaha, and America. Convicted or incarcerated for a felony. Forester's strong foundation. If jail time has been served, we'll consider 5 years after parole. For criminal activity with no jail time, we'll consider 1 year after parole. All other carriers will get declined. Even National Life Group will decline this, okay? So just, and like I said, it's just to know that we have all these alternatives, even if they were in some trouble. We at least, for example, if you ask the questions to your client and you know that they had some sort of issues with the law, right? And they were in probation and you know that it passed 3 years, you're not going to submit an application with America because you are right away you already know that it's going to get declined, because this is like a guideline, underwriting guideline, pre-underwriting guideline, but you will know that Foresters will approve that client. So instead of going through the whole process with this carrier and telling your client, oh, they didn't approve you, then you might as well go with the carrier that you already know that takes that type of risk when it comes to the client, okay? Diabetes, this is a big one. America, under the age of 30 is decline. Decline if in the past 2 years diagnosed, treated, meds for insulin shock, coma, amputation, eye, kidney problems due to complications from diabetes. Now, this type of diabetes, it's okay. And if it's fully recovered, and all others required underwriting. There's certain types of diabetes that can get approved with underwriting. I've seen some clients that they don't even take insulin, they just take the pill and it's completely like regulated, but they were already diagnosed with diabetes. And I forgot what's the name of the medicine. Totally forgot, because I used to remember the name of the medicine. And of course, your rating is going to be higher, your pricing is going to be higher, but there is some carriers that will approve you even if you have diabetes. Now, if it's already a very advanced diabetes that you've been through coma, amputations, kidney problems, or complications, then most likely it's going to get declined with probably most of the carriers. Now, John Hancock has very specific underwriting guidelines, and sometimes they do approve things that not all carriers will approve, but that's if we are in that case, right? There's a bug here. So HIV/AIDS, it will be declined with all this. Now, John Hancock has a product, and I'm telling you this because we've done this in the past for a client, and they were approved, a very high rating, but they were approved, okay, for a whole life. So there is options. Obviously, we have to see how advanced it is, and we have to see like what medication are they taking, if it's controlled or not, but there is options for that. Now, hospitalized for high blood pressure, we need to call underwriting. For some of them, we already know that Mutual of Omaha Term Life Express is going to get declined. America, we're going to call underwriting Foresters and CFG because they might want to see medical history and all that. So look, I don't want to go over all of them because I'm going to bore you with all this, but I'm going to send you the link right now, actually. I'm going to send you this link through here and through the WhatsApp group, and we have a Facebook group too, so I'm going to send it through there. Metformin, thank you, Cynthia. Yeah, metformin. Metformin is the one for the diabetes. Perfect. Okay. So that's for you to have access to this grid. And as soon as you hear of a client, oh yeah, but they decline me because I don't know, because I have high blood pressure. And then you can go to your cheat sheet and be like, oh, wait a second, I can have a solution for you. And that's going to make us resourceful. And we know that we're going to have a solution for that client. It doesn't matter in what circumstance they're at this moment. Let me go over another one that I've seen. This is all decline. This is all decline. Oh, this is a chronic disease with, this is very, very common that I've seen. So Foresters will take this, Mutual of Omaha can consider it, and then CFG and America will decline it. Now, let me see what else. And Foresters will kind of approve you for a whole life, actually, for the strong foundation if they use a walker, wheelchair, or electric scooter. Okay, underwriting. Let me there. Sorry, guys, I have to unmute. Mute participant supplementary. Yes. Okay. Okay. So you got the link. I'll send it to you right now through the WhatsApp and the Facebook, but I also send it through this chat. And then you can also take a look at this link on your free time. So you can take a look at all the disease and which will be the good company. Now, I'm talking about term right now and the simplified underwritings. If there is a case, now IULs are sometimes even stricter than terms, okay? Because you're talking about cash accumulation and you're talking about a permanent policy, that there's more things involved. That's why National Life Group has high standards, and AIG too, when it comes to approving clients. As a matter of fact, not like the last policy that I was able to write with National Life Group, it went up the rating because of their credit score. So because they had a recent bankruptcy, so the company told me, well, that's a very high risk. The reason why, it's because they consider it that people that under in a certain age range, if you don't own a house or your credit score is really bad, or depending on the zip code that you live, your, what did I say, the risk of dying is higher. So the risk of you dying, it's higher depending on where you live, and depending on if you own a house, your credit score is bad, if you had any bankruptcies. So according to them, rates of mortality are higher in neighborhoods that are not really good, that people that are, for example, 45, 55-year-old and they don't own a house. It's just the way they do LexisNexis, and for them, it's a high risk classifier. So my client's policy was a little bit more expensive because of that fact. So just so that you know, so some companies take very serious bankruptcies and they won't insure you if you have a bankruptcy, but other companies will do that, just so everyone knows and it's not surprising something like that happens. Okay, I'm going to leave it open to questions before I jump into the other topic that I wanted to talk about. Two more topics that I want to talk about. Okay. Dice, what is happening now with the COVID issue? Okay, so they are asking, and that's a good question, Palmina, thank you for asking. If you were already insured, there's no problem. Like actually you were, for example, National Life Group send out a flyer to all of their agents so they can send to all of their clients, letting them know, hey, you're covered for any riders for chronic illness, critical injury, or what's the other one? I totally went my terminal illness for COVID, you're going to be covered because you got it before COVID. Now, if they have a questionnaire on the policy when you do the application, and they're going to ask questions regarding COVID. Now, we have to remember, COVID, it's not diabetes. Yes, you can die of COVID, but it's not a chronic illness. Okay, so it's going to be the way that they're going to, it's like if you had the influenza. If you have the influenza right now, well, they're not going to approve you right now because they already know that you're at risk, right? It's kind of like the same thing. But let's say you had it last year. This is not going to put your percentage of dying, your risk of dying higher. So the way that they're going to deal with COVID, and I'm pretty sure they're still working on this, but they're not going to approve you if you have it right now, but I'm pretty sure that if you apply a couple months later and everything went well, you recover perfectly, it's not a risk that it's that high right now because you already went through it. So it's not like diabetes or cancer. I hope that answers the questions. But if of course a client tells you, well, I have COVID right now, I'm not sure what's going to happen, can you do a life insurance? Well, no, because they're already going through that. Okay, anyone that might have questions before I jump, I just wanted you to have this guide. Because I
have a question.
Who is that? Vanessa. Okay. Hi, Vanessa.
Hello everyone. Sorry, came a little late, but I was able to. to hear. Question. So you're saying that it's not a chronic illness, right? But what if, for example, my mom had her life insurance before everything happened, and she got right now she actually has diabetes, and she got it real bad to a point that they said that you almost can die or anything.
Mhm.
Can then the client ask for that percentage, like how it's like certain percentage that they give you the life insurance when you're maybe when you have like a cancer, chronic illness like that? Is that then it doesn't apply to the COVID?
So you mean like your mom had chronic illness because of COVID?
Yeah, for example, that she got the COVID, right? And she had her life insurance before the COVID
Mhm.
happened. So she's already insured and everything. But because of the COVID, she got very, very sick. She got to the hospital to a point where she's might be, in bed, almost dying.
Okay.
Can they do that? De que le dan el dinero?
So if your policy that she, for example, I'm gonna talk about National Life Group, okay? Because I've had a couple clients with COVID, and as a matter of fact, I had a client that the wife called me and she told me my husband is dying. The doctor told me that he's not gonna make it um, within the next couple of weeks. So in that scenario, because the doctor told him the husband is not gonna make it, we had to call National Life Group to start a claim because there
Oh,
is
okay.
a terminal illness rider on that policy with National Life Group that we can actually take advantage of it right now because it's 20 terminal illness rider with National Life Group. It says 24 months. If the doctor tells you you have 24 months of life, that's it, you can take advantage of that rider. Now, let's say chronic illness. Chronic illness, which means that you cannot do any two of the 5 living activities within a 90-day time frame, which is eating by yourself, clothes, getting your clothes, taking a shower, going to the restroom by yourself, all those activities. If you can't perform 2 of those activities for 90 days, then even and there's some people that happens because of COVID, then you can turn in the rider for chronic illness. Now there is
Oh,
critical
okay.
injury. Let's say you go on a coma because of COVID. You can turn on your rider. Now, it is going to depend on the company that you have. Remember, each company has different regulations. So, for example, I'm not sure which company your mom has as for a policy. Most of the carriers are going to cover you for terminal illness. So, if it's terminal, then you can talk to your insurance company because I know your mom got this a couple years ago. So
Well, I mean, it was pretty much like an example, but thank God that she's not in that. But it was just like a question, just in case I have a client that happens to have that question.
So that's why it's so important to know our carriers
Mm-hmm.
and to know what benefits we're offering to the client. There's some carriers that don't offer you living benefits. It's just pure life insurance. You have to die or a terminal illness to be able to get this policy, your insurance, right? But that's why it's always good to explain to our clients what do they have and if it's going to cover them or not. But I hope that answers your question.
Yes, thank you.
Perfecto. Any other questions? Yes, Susana.
Is that similar to the total secure whole life, or is that a like total separate thing? Total separate.
So,
Okay.
so when it comes to the benefits, Total Secure Life, it's with National Life Group. When it comes to the benefits, it's a permanent policy because it's a whole life. And I know you took training for this. For it's a permanent. So you're gonna have the benefits of the living benefits, which is the terminal illness, the chronic COVID. That's not gonna change. Same carrier, same rules. But I was talking, which is gonna apply. It's just that I was talking about the term policies that offer you, which I want to say illnesses you can get covered with certain companies. But National Life Group has across the board, like all the writers for all their products. It doesn't matter if it's a whole life, if it's an IUL, if it's a term, unless you have a pre-existing condition, then they can take a rider away, but they have to let you know because you have to let your client know. I had a client that did not qualify for living benefits because they had they had some health issues in the past. So I had to let her know, hey, you're approved and you only get terminal illness and lifetime income, of course, but you don't get chronic, you don't get any critical injury or anything like that, because the company is already telling me. And then you explain that to the client. I hope that makes sense. Yeah.
Yeah, a little, because I was trying to understand that training today, and it mentioned all those that you're saying, the chronic, illnesses, in order to be able to get those benefits, the living benefits, Ryder. Okay.
Now, it is very important. I know some of us here are in California, some of us are in Arizona. California, it's very strict when it comes to the regulations and everything. So this does not apply for Arizona yet, but for California, we all know that health insurance, it's a must. The federal took the law away, but California came up with the law that if you don't have health insurance, you get a penalty, right, in your tax return. Now, because of that law, also, your chronic illness won't be valid if you don't have health insurance. And that's super important to disclose to the client, because then the government was like, wait, so they're not going to want health insurance because they have their life insurance that is going to cover them for those living benefits, right? And that was not the point. So California has very strict laws when it comes to that. And we also have to disclose that to our client when it comes to living benefits. And not all carriers offer living benefits in California, because they have to go through a certain government approval to be able to offer living benefits in California. So far, I think it's like 4 or 5 carriers only that offer living benefits in California. Arizona, you don't have to worry about that. Okay. Questions that you have of that before I jump into the next part of the training? No? Okay. Before I jump into IULs, because I wanted to go over a couple things in IULs and 401ks and all that interesting stuff, I wanted to share with everyone. I know that we've been waiting for all these approvals to get appointed, and it's been taking a while even for us and everyone, but I just want you to get an idea of commissions, which we talked about with individually. But of course, I want everyone to start already strategizing what's going to be their monthly strategy once we're up and running, or their weekly or their yearly strategy. So for example, let's say you only do plain terms and you're protecting mortgage, right? An average monthly premium for like a 55, 60-year-old term policy, it's around $80. I mean, it's an average. It doesn't mean that it's always like this, right? So that's an average premium amount. If you're at an 80% comp level, okay, with this carrier that you're writing, let's say they're offering you 80% with this carrier, and you're writing 4 policies a month, and the average policy, it's $80 a month. That's a monthly income for 4 policies of $3,072, which is a yearly additional income of $36,864. So let's say you write 6 policies a month. It's $55,296, and I'm going an average of $80 of a month per policy, which most of the agents here that have in the past written business with IULs and whole lives and permanent policies know that the average is not 80. It's usually about $150 to $200, right? So if you help a family with a more structured and complex policy, and for 150, and let's say that there you're at 60%, I'm just giving an example of a 60%, and you write 6 of those a month, that's 77,760 additional to income. So the reason why I wanted to share this is for us to kind of plan ahead. And I know each one of you has their own comp level, and some of you are, I don't know, 80, some of you are going to be 90, and depending on the carrier. But so you can see the level of income that we can make in this industry, especially that we're going to talk about higher comp levels. Okay. That's why and I can share this super easy calculator that we have in Excel. And the reason why there's more blank spaces, because down the road, we're going to show you what you can do once you learn and you start building an agency and you have agents in that agency, and then that pulls another game in another scenario, right? But this is just for you to get an idea that it's not that complicated. If you just want to focus on term policies that are very simple, plain vanilla, and let's say $50 a month, $50 a month term, and you sell 8 a week and you're at a 90 contract, 8 a month, that's 51,840 additional. And I think that it's a very good additional income for our pocket. That's why I just want you to share this with everyone so everyone can know what actually can we do with our own pen. And why I'm doing an average premium of $50, it's because sometimes when we start, I'm going to jump into IULs, and sometimes they look very complicated. And I just wanted to know, like, terms are easy. Like I mentioned, if you market it as a mortgage protection, and you already know that you can insure clients that had cancer in the past, of course, depending on the regulations and everything. And I'm pretty sure 2 policies of $50 a month, it's simple. It's especially if you have a family, because you want to insure the wife, you want to insure the husband, and maybe they want to do, or if you do their whole financial plan, you want to also insure their children. And most of families have 2 children. That's already 4 policies with one family. And usually each policy is over $50. So it's not that complicated, and it's not that hard once we get the ball rolling to be able to do this, which one of my goals is to be able to measure this weekly, just because what we measure, we can improve, and we want to make sure that we improve it. And once we see that money coming into the bank account, we even get more excited to be able to produce more and reach our goals. Do you guys want me to send you this little spreadsheet so you can have it for your records? Okay, I see that there is questions. Let me see who has questions. Can you please share? Yes. When can we start producing? Okay, so that's a good question. I know that there is a couple of you that already got approved with some carriers for term policies. Not everyone. The way I know it's taking a while. So the people that already got approved, which already know, because I spoke to them already, you're able to produce already with term policies with those carriers only. Now, National Life Group, this is the issue. And I don't know if Isaac spoke to any of you. I think he did. Yeah, he did, because he mentioned that to me. So we are already moved. We're not with Difference Financial. We're under Mike Duncan, which is the BP of National Life Group, okay? Now, the issue that they have is that they're transferring to put our commissions higher. It's taking longer than what they expected. So we're moved. You can actually write business, but the commission that we are in, it's the same commission that we were in the past with National Life Group. So the issue is that we will be getting the same commission that we were getting in the past. Now, if we wanted to avoid that, but we already spoke to Brittany and Mike Duncan, and they told us we already started the process. October 1st, they're giving us the change, but it can take 2 weeks after October 1st to do all the transition. Because of COVID, all the personnel is working from home and they're taking longer to do all the process. So if you write a policy right now, you can write it. You are appointed. The people that are already transfer, it's over, you receive your email. The issue, it's just the commission part of it. So it is going to be depending on, like, for example, I'll be honest, I had a client that really needed a policy. So I was like, I don't care if I'm not getting fully commissioned, what the new comp levels, because I'm a very low commission as well. So I'm like, I honestly don't care. I have to insure my client. So I'm just going to submit the application. And it's just because of my ethical that I needed to insure my client. Imagine I'm like, no, wait until my commission is higher, and then something happens to my client, I'll feel terrible, right? So it's up to you. And when it comes to National Life Group, when it comes to the other carriers, we are on the process. Most of you submitted their appointments, and it's just that companies are telling us when to submit paperwork. They're telling us who's getting approved, who's taking a little bit longer. It doesn't mean that because you had an issue in the past that it's taking longer. It's just the way they're processing everything. And I know a couple of you already got approved with for term policies. We're hoping that by the end of September, have at least all the simplified underwriting companies and whole lives, but National Life Group to get fully compensated as the comp levels that we did, and it's gonna take a little bit longer, probably until the second week of October. And we have our website coming up this week too. We have just to give you an update, we have a meeting. Let me stop sharing this. We have a meeting this week as well with web developers for the back office that they're creating for everyone. And then for the app, because we're also creating an app for everyone, but it takes a lot of time. And then they also created our Excel sheet for us and our fact finder and all those tools that you're gonna need that we're gonna be sending you so you can have them. They're also creating that, and a lot of things are done. Your comp that we already spoke to you about it's already created as well. Actually, let me see if I can share that so you can see how it looks. Give me a second. Let me pull that up. And does anyone has any questions of what I mentioned before I share this comp? No? About this whole process? And if you have any questions, you're like, hey, Sandra, I want to write a policy with National Life Group because I have a client. Can you help me with this? Be more than happy to help with that. Well, it looks a little blurry, but, and all these charts that we're going to need with all the percentages and the products, and depending on your comp that you're in, and then the carriers that we have and everything, it's already created. Also the structure that we have, the contract that we have for each one of you, stating, I can't move this back, stating that we're not holding any clients from like that you might have. What's your responsibility as an agent? Let me see, let me show you right here. Share screen. Your responsibility as an agent, and that is to have your license, your E&O, how the compensation, how it's gonna be important for you, chargebacks, so you're responsible for that. All that was created, and you're gonna receive all this information soon with all the emergency contact that we're gonna need from you and all that. And kind of like the background questions that we need, okay? So just to share that before I jump into the other subject. Any other questions, guys? No? Okay, I'm gonna send you the Excel as well to the Facebook group and to the WhatsApp, okay? So let's do a quick training on IULs and 401ks, and I'm gonna share this presentation because this presentation, you can actually use it for certain clients that you feel comfortable using. I know some of you feel comfortable with IULs. So this is leverage on, let me see, can you see my, oh no, I'm not sharing my screen. Okay, there. You can see my screen, right? And I know that we talked in the past, sharing this, there, percent. Talked in the past about 401ks, IULs. When we help a client, let's say this client needs help with planning. Not only a term life insurance, not only a mortgage protection, but we can help them with their finances. Or this is going to be the second level of the training in reality. Once we are able to get experience and hands-on on the term, then we can jump into this type of training with IULs and 401ks that requires a little bit more of lingo and more of our work, if you want to say it, because we need to structure correctly. Once you are working with a client and you're helping them with their finances, okay? You're creating a budget for them, because everyone in here is going to be able to create a budget for a client. You're helping them get out of debt because it's part of the cycle that we created for for their financial health, right? You created a budget for them. You're helping them get out of debt. with the technique. Maybe you're helping them pay their mortgage sooner by just adding $200 or $300 more to the principal, and you were telling them how to do that, and you're helping them proper protection, DIE method, which we talked about, debt, income, mortgage, and education. And you're also going to help them plan for retirement. And then all of a sudden, they have a 401k here, an IRA over there, and you already know that taxes are going to be bad, right? Once they retire. So IUL versus a 401k. And this is it's very common information that we've seen in the past. Hi, jump into super slice. Okay, so here it's what happens. Everyone wants a comfortable life, but aren't playing to their advantage. So what do we mean by this? When we're planning financially for a client, we know that once they retired, if we are familiar with taxes, probably they're not going to have a lot of write-offs, right? They're not going to have a lot of write-offs, and probably they pay off their mortgage once they retired. They don't have a child. They don't have any dependents. So the tax bracket might be higher than what they were paying when they were younger, right? Now, what happens here is that everyone wants the highest rates of return, the lowest cost to manage their money, of course, no losses, of course, and everyone forgets about the biggest killer to the money, which is Uncle Sam, taxes. So everyone is like, okay, I want 12, 50% of rate of return on my investments, and 1% or less of management fees a year, and 1% is what they charge financial advisor to manage your investments or your stocks or your 401k. And I don't want to lose my money, but then I'm forgetting about taxes. And I do know how to stress this information. Like, I've had people in the past, and I've shared this with a lot of associates that come to me after they took all of their 401k because they turned 65, $150,000, and they didn't know they have to pay ordinary income tax on that because someone, the neighbor, the uncle, the tia, the tío, told them that once you're 59 and a half, you don't pay taxes, which is not true. You do pay taxes. It's just that you don't pay a 10% extra penalty, right? And I get, my heart, it gets broken when I see that, because they already spent all the money that they took out. They buy a house and they're stuck now with an IRS debt. And you know that Uncle Sam, it's not going to forgive an IRS debt, right? And then it affects their Social Security income if they make a lot of money on their tax return the year before they actually start getting their Social Security, which even affects them even more. Okay, so what happens with taxation, and I'm pretty sure everyone's seen this in the past. We earn money, they tax us. We spend it, they tax it. We save, they tax it. You die, they tax it. We pay taxes for everything, which is why we have an amazing country, right? So how high are individual income taxes in your state? Depending on your state, it's how high they are. And guess what? In California, it's one of the highest one. And that's why, to be honest with everyone, we have considered in the past moving out of California to Texas or Washington, because taxes, it's 13.3%. So if you make $1 million, imagine how much tax return it's on that, just in state taxes. Now, there is something on top of this. I'll be very honest with everyone, and we all have to know this because we're in the financial industry, in the financial services industry. Taxes are not going to get better. We are in a lot of debt. After what happened with COVID, the country was never in this scenario, not even in the Great Depression. Unemployment is really high, and our debt, it's really, really high. So what happens in the Great Depression, when we had a lot of debt, taxes went up to be able to cover that. So if we kind of do like an educated guess, probably taxes are going to go up, right? Because of that. And then you can add to that we have new government probably soon, and all these things that are going to be adding on. Okay, so we don't know how much are they going to increase taxes, but we do know that for some way or another they're going to have to recover from what happened. So taxes is going to be one strategy. Other strategy is going to be cutting Social Security income and all those things. Okay, and this is not to scare people, it's just so we are aware. So this leads to opportunity. It's an opportunity for us as agents to be able to offer these type of planning and products to our clients. Okay, here it shows the U.S. federal margin income tax rates in the last, what is it, I want to say 100 years, probably almost 100 years, 90 years. So in 1918, the tax rate was 77%. Well, that was the highest marginal tax rate, 77%. So for every dollar that you were making, you were paying in taxes 77 cents. Of course, it was depending on what bracket you were in, right? And then in 1944 is where we had, where the country was in more debt that we have seen. And that's why taxes were at 94%. So in reality, these past years, we've been enjoying the lowest tax brackets, the lowest tax rates these past years. So for sure, we know that something's going to happen there because it doesn't make sense, right? Just as I tell my clients, like, it doesn't make sense that right now the stock market is just going up and up and no one's working. Something similar to that. So why in the world will this matter if we are comparing an IUL strategy versus a 401k? How they are taxed is one huge key difference. Okay, so, well, let's talk some common sense. We know, and this is why it's a presentation that you can use for your clients, right? We know that pay taxes, that if you had to choose to pay taxes on the seed, on the harvest, which one would you prefer? Obviously the harvest, right? I mean, we are choosing the seed because the harvest, we don't want to pay taxes on that, right? Because we know that it's going to be much more. So we've seen these three buckets, and one of the three buckets that you're going to have also on your other presentation, the regular presentation for financial planning, which you're going to see it very soon, which it talks about the red zone, the blue zone, and the green zone. Okay, we know that they tax everything. Now there is different things, different buckets where we can put our money. And depending on the zone, it's how much taxes we're going to pay on that. We know the red zone are wages, interest income, dividend, real estate, short-term income, mutual funds, and savings accounts. Why? Why is red? Why does it have a lot of holes in there? Because when you earn, let's say your wages, you pay taxes on that, right? And then you put it in a savings account. And any capital gains that you had on that savings account, if it's over $10 in a year, you're going to pay taxes on that because they're going to send you a 1099 interest to put on your tax return, right? Now, if you have stocks and you sell them, okay, once you sell them, you have to pay taxes on the capital gains on that stock. The tax deferred zone, which is the zone that you don't have to pay taxes on the money on the growth right now, but you'll pay taxes later, which is one of the zones that the IRS created for people to be able to save money for retirement. And also real estate growth. Real estate growth, there is a technique actually that you don't have to pay taxes when, let's say you sell a property and you buy a bigger one, and then you sell that one and then you buy a bigger one. As long as you're getting a bigger property, you're not paying taxes on the sale of that property. That's what we call real estate growth, because you're deferring those taxes. This is how Robert Kiyosaki made a lot of money and avoids paying taxes, actually, if you want to know. Individual stock growth, you don't have to pay taxes on the growth until you sell that stock, and then you pay taxes on the capital gain. So you're deferring your tax return, okay? Your taxes. Retirement plans. 401ks, TSAs, TSP, SEP, IRA, simple tax deferred compensations, 403bs, 457s. All of these are the same. It's just the name depending on which industry, or if you're private or public, okay? So 401ks are private. Usually private companies have it. 403bs are usually teachers, TSPs, for example, the USPS office has TSPs for all their employees. It's more like a government. I know customs also, they have TSP plans. They're very regulated, and you're not paying taxes on the growth right now, but actually it serves you as a tax deduction when you put money in these type of accounts right now, but you're going to pay taxes once you take it out. And then traditional IRS, which stands for individual retirement accounts, right? So then we have the green zone, which is one of the zones that you're going to explain to your clients, which are municipal bonds, Roth IRAs, and cash accumulation inside of life insurance contracts, such as index universal lives. I'm pretty sure you've seen this in the past, but it's so important for us to know that we need to have our client diversify their portfolio in this. We cannot have our client all their eggs in one basket. So which means that we cannot have our client put all their money in just 401ks. But I also don't advise my clients to close their 401k. I always ask my client, are they matching you? Yes. Okay, take advantage of that because it's free money, right? So you want to match the amount that they're matching you as well. And you want to have that tax deferred, but you also want to take advantage of that tax advantage that you get here. Roth IRAs, I have a Roth IRA. The only thing with Roth IRAs is that they're very regulated, and as well as IRAs and 401ks. But Roth IRAs, if you start making a certain amount of money a year, you don't qualify to be able to have a Roth IRA. And in the amount that you can contribute to a Roth IRA, it's very, very small. Okay. So I haven't seen if anyone, no, there's no questions. Okay. I am glad there's no questions. So what happens with an IUL? Remember, we said that it's a cash value policy and it allows you to get lifetime income, right? With no tax. Because it offers you a financial protection. It gives you flexibility. It's tax deferred growth. Yes, the growth, it's tax deferred. There's no capital gains tax on the policy. Now, let's make sure we know this. There's no capital gains tax if we know how to structure the policy and if we know how to help our client take the money as a pension. And that's something that we really, as agents, it's our responsibility to be able to know how to do this, okay? And now I'll talk about it a little bit more. There's no market risk because it has a 0% floor, which means that the client is not gonna lose money if the market crashes. And there's potential market-like returns, index credit and methods. You know, we use the S&P 500 a lot, but there's also, like, for example, Allianz uses a lot of the Dow Jones and other indexes too, and AIG too. It could be fund more than the 401k. A 401k has regulations. You have access to the money before 59 and a half. You don't have to be 59 and a half to have access to the cash accumulation inside an IUL. There's no RMDs. Are we familiar with RMDs? Required minimum distributions. So let me dive a little bit into this. So the IRS says, okay, you can't touch the money in this account until you're 59 and a half, but you can also not keep it in there and all the way into your 70, like it's say you're 70 and a half and you're not touching the money, you can get penalized for that. You have to start taking money out because you haven't paid taxes. So they want their taxes. So you have to start taking at least the RMDs. RMDs, there is an exact amount depending on the amount that you have on that particular qualified account that you have to start taking every year. If you don't, they'll tax you 50% on the amount of money that you were supposed to take that out that year, okay? Now, there's income tax-free income. Well, actually, tax-free income. There's two income in there. It can help you with children's college. It's not like the 457 plans that actually you have to use the money for college or you'll have to pay taxes. No, in here, you can use it for college. You can use it to buy a house. There's some methods, the way they structured, that they even use it to pay out debt as well. You can fund completion and guarantee to surviving spouse. That's true. That could also be done on that policy. We already talked about lifetime income, which is tax-free. Life insurance debt benefit. 7702 private plan. Yes, accelerated living benefits, which some of the companies, and no loan limits or repayment requirements. Okay, interesting. Now, Sandra, what happens, what can an agent not do wrong for the client to have to pay taxes on the cash accumulation of policy? Not explaining the client that the way they take the money out of the policy is as a loan. Or if they have a rider for lifetime income like National Life Group and some other carriers, that's a possibility, but it has to be as a loan from your death benefit. Because on the IRS code, it says that if you don't take it out, that the benefit from a life insurance doesn't pay taxes. But if you just take the money out and it's not as a loan, then it's not a benefit from my life insurance. So you have to take a loan out of your death benefit of the policy. I want to stop because there's questions. Offer the infinite banking concept. Oh, I've heard of that. You know what? I have to get back on you on that because I know there's big carriers that do this one. And if they do, what's the name of they have a product that they do premium financing. I'm pretty sure they might have that concept, but I'm going to put you on my notes because I'm not very honest sure. So I'll write it down and I'll get that information for you, Fabi. So let me go back. So we were, let me see. Yes. Okay. So we have to make sure we take this as a loan. Now, let's say we are on year 60 of the policy. You're 60 years old and you already accumulated 150,000 and you cancel the policy. You don't have the policy anymore. You want to cancel it completely, not even a transfer, it's a cancellation. You're going to have to pay taxes on that, on the capital gains on the policy, because you're not taking the policy, you're not taking the cash as a loan, and you're not taking advantage of the lifetime income. You're just canceling and taking all your cash accumulation. Then you pay taxes on the capital gains. And our job is to explain that to the client. Because then what happens, the client, it's like, hey, they told me it was going to be tax-free, cancel it, take my money out, and all of a sudden, the company doesn't tell them. They're just going to receive a 1099 interest, and they're going to have to report it on their tax return, and they're going to be surprised. So that's why we have to know. Now, why a loan? Loans don't pay taxes. If you get an auto loan, do you pay taxes on the auto loan? No, you don't. So it's the same scenario. It's how they structure the policies as well, and that's why we also have to know how to be structured correctly. I want to give big shout out to Susana because I know she's been taking advantage of all the training with National Life Group. If you're appointed with National Life Group, we updated the calendar for September. They have amazing training on how to structure policies, on illustrations, on different products, and you can ask questions. And then at the end, they send you the presentation. So I know Susana is going to be training soon because she's been learning a lot about that. Okay, when can the client borrow on their money? How do we start the process? Okay, so as soon as there is the surrender value and the cash accumulation, there is money on the surrender value when you see an illustration. I have to show you an illustration, but on an illustration, it shows current accumulation and then surrender value. When we have money in there, the client can start taking loans. There is no, oh, wait, you have to wait 11 years. No, what happens is that at the 11th year, it's like kind of like the break-even point that you can see your surrender value equals your cash accumulation. So there's no penalties for canceling or taking the money out, but you can take out a loan before that, okay? And how do we initiate the process? We have to call the company, and there's forms that need to be filled out and that the client needs to sign to be able to take that loan out, like a contract, like a loan contract that you're taking out of your death benefit. And it's not a difficult process to be able to do that. Actually, when we know an agent that had a client that was funding IUL's like max funding, and this is a complex scenario, and then was borrowing money to fund it again because of the interest rate that it was generating with the IUL. I know it sounds very complex, but he was doing this, and it's not like he had the policy for like 7 to 8 years, no. And it was working how it was growing. And it's kind of like similar how they do premium financing actually. So I hope that answers your question. As soon as the policy has cash accumulation on the surrender part, you can start taking loans out of the policy. Now, if there's not a lot of cash value and you want to take money out, you can do it. You just have to be careful to not all of a sudden stop making payments because you don't have any cash cushion in the policy, that because you're taking all of your cash accumulation. So you just have to make sure that you're maintaining your payments to the policy or to the savings plan. And that's one of the things that you structure with the client. Actually, when you're doing illustration, you have the opportunity to kind of illustrate, oh, the client in 10 years wants to take $11,000. And you kind of illustrate that and see how it looks. And you can do that. It's obviously it's an average. Okay, perfect. Okay, and well, this is just an add-on, the cost of a 401k. What happens with 401ks, it's the fees. You always have fees. It doesn't matter if you lose or if you made money, if the market performed or did not perform. There's a lot of fees when it comes to 401ks that they can eat part of your retirement. Now, a lot of people has told me in the past, Sandra, but insurance policies have fees too. Yes, they do have fees. And that's why the first couple of years that you have your policies, the cash surrender value, it's not as high as the cash accumulation because there's fees associated with it. And on top of that, you're paying for the benefit of life insurance and lifetime income riders. But if you do the math, I'm going to send you there's an article that compares the pricing of an IUL and a 401k. I believe it's with an IUL with AIG. And it compares the pricing, and you can see the difference in pricing, especially because here it's assets under management with a 401k. So they're always going to charge you that percentage. They're always going to charge you. It doesn't matter if the market performs or not. You're always going to get that fee. There's some companies that charge 2% and then some others that are 1%, but it's never lower than 1%. Okay. So there is a couple of articles here that you can also take a look at that can help. And then I'm going to share this presentation with everyone. Everyone has to read this book, The Power of Zero. And this is an image from that book. And it talks about how the index strategy can, the long run, help you, long term, help you than having your money directly in the stock market and in the S&P 500. So the index strategy, how it's locking your gains, it's the blue line actually, and it's showing just the positive results. Of course, if the market does really good, the S&P, it's not going to give you all the gains, right? But if you lose, it's not going to lose all the money. So you can see here, and I strongly recommend you to read this book. It's a very, very, and I know Caro has read this book in the past because we talked about it in the past. The Power of Zero, it's going to completely shift and change how we look at IULs. Life insurance as an asset class. So these are some articles as well that you can take a look at it. And let me just text here. These are the 4 phases of retirement. Let me check who has questions. Yes, it's amazing book, helps you understand how the company really works. Yes, yes, yes. So these are the 4 phases of retirement, okay? And this is how, it's basically what I went over with you, but I kind of illustrated for people that are more like picture oriented. So you have 4 phases. You have the contribution phase, which you're young and you're just contributing. Then you have the accumulation phase, which is accumulating that interest rate, then the compound interest that we talked in the past. And then you have that phase when you start taking money out, right? And then you have the last phase when you passed away and you transfer that money, that wealth, right, to your beneficiary. Now, on tax-deferred plans, which are the qualified accounts like 401ks, IRA, SEP, simple pensions, These two phases, your tax favor, because you're not paying taxes on that money. Actually, it's giving you a tax benefit. Probably you heard your CPA or your tax preparer, hey, open an IRA so you can save some taxes today, because they're tax favored right now through the contribution and the accumulation method. But your tax when they withdraw, when the withdraw phase is here, and the transfer phase too, because they also pay taxes when you transfer that money. Now, the IUL, it's the Index Universal Strategy, life strategy. On the contribution, it's after tax, because the money that you put in there, you already pay taxes on that money. It's not like it's giving you a tax benefit right now, right? But the accumulation, it's tax favor. The withdraw, it's tax favor. And guess what? If you passed away and this is transferred as a life policy, it's tax favor too. So does it make sense to defer taxes and possibly pay more later? Not really, right? Now we do offer, we offer IRAs. We have Roth IRAs with National Life Group. We can do plans with IRAs that they can put $100 a month. If a client wants to do an IRA, and that's to complement your financial plan. And it's one of the things that we're going to be learning about. But we know that if we're strategizing correctly for our client, an IUL has more in favor when it comes to taxation. Okay. I promise I'm almost done. This is just talking about the living benefits that we talked in the past. Let me just see right here. What time is it? I went over my time. I'm so sorry, guys. Does anyone has any questions? I'm going to go over this really quick. Are you awake? Are you still awake? Hope so. Okay. So what if the unexpected occurs? So assuming we have 100,000 in an IRA, an average qualified plan, the market drops 50%. So let's say the market drops 50% in an unexpected incident. So we have $50,000. So real estate value drops 30%. You need 30,000 for income. Take 45,000 before taxes. Taxes are 33 and a third percentage. That's 15,000. So 10% penalty of 4,500. You have $500 left before state penalty. Imagine that. So this scenario, now imagine in an index alternative, the market drops 50%, you still have $100,000 in there because you're protecting. The real estate value drops 30%. So you take 30,000 for income so that you keep 70,000. There's no taxes and there's no penalties, and you still have $70,000 left in that account. And then you still have a living benefit, right? Which is the life insurance, because you haven't canceled the life insurance. This is just assuming you have only 100,000 in accumulation. It's just going to give you a little example. Okay. And it's putting you a scenario, either you get a check for a critical illness or chronic illness rider for 200,000 for a heart attack, stroke, or you get a card that it says get well soon. It's just putting it in perspective, no? So, and we finished this presentation by actually recommending 2 books. Isaac had the strategy in the past. He actually bought like 20 of these and like 10 of this, and he was giving it to certain clients, and it actually helped. So it was a good strategy, because some of those clients were converted to 401ks rollovers actually, and others as IULs. So it's a strategy as well when you start investing in your business and you start seeing how it's growing, because education, it's power, and you're only educating your client and you're offering them a book. It's not even coming from you, like the information not only coming from you, but it's coming from another person, an expert and an author. And that's why I strongly recommend this. I love The Power of Zero, but Tax-Free Retirement, it's a really, really, really good book. So what is next after you do this presentation? You set up an appointment to set up an IUL and take care of you and your family. That's how you present this. Now, why I wanted to share this, I'm going to send it to you guys. Actually, you can download, I have it on Google Drive. I'm going to send you the link so you can download it and you can study it at your own time at your house. Once we do a financial plan, and we know how to do those financial plans, it's going to be very easy to present this to our client, because we're going to know most of the people are not prepared for retirement. And if they're prepared, what's the common thing to do? To put it on a 401k or an IRA. So they don't know about these strategies. These strategies, most of the wealthy individuals are the ones that are familiar with these strategies. And that's why we have to become experts. Now, we started with term policies, and I want everyone to know what's a term policy and be able to sell term policies like if it was candy. Why? Because they're super simple and they have only one purpose, right? And then once you are able to know that arena, then you can upgrade to these type of complex financial services that we're here to help you with those appointments, to close them, and to structure those policies correctly, because they have to be structured correctly. There's some scenarios that we have to do minimum death benefit, max cash value, and our comp gets cut, which means that we're going to get paid less our comp because they're not getting as much as that benefit, but we want to do what's right for the client. So whatever is going to benefit the client is what we're going to end up doing, especially if we're supplementing this instead of a 401k. We want to make sure the client has their guarantees and their average, right? Illustrating rates. I'm sorry for having you here past 8. Questions that you might have, probably a lot. It's okay. Remember that September 19, we're having a training in person, whoever's able to make it. And that training, you should leave that training being able to know how to do a financial plan, how to do a fact finder, and how to illustrate, and how to sell term. And the basics of annuities. Basics only, because I don't want to get everyone so overwhelmed with that. But I hope this helps. One of my main goals as well is to start putting you on the CRM so you can start putting your prospect and your clients. Now, my question, here's a question from Palmira. Is there a certain minimum amount to start an IUL? That's depending on your age, Palmira. So if, for example, if it's young children, you can even start an IUL with $35, $40. But if it's someone that it's already 35, 30 years old, minimum at least it has to be like 120, 125, 150 if you want to see the growth. And you have to structure it in a way that they have to increase that amount, because it's not only life insurance, they're paying for retirement as well. So they're saving for retirement. This is how I tell my client, do you think saving only $50 to $100 a month is going to get you $1 million in retirement? I don't think so, right? So we have to save accordingly. So is there a limit? And that's a really good question. No, as long as it doesn't make, not us, but I've known colleagues that have written IULs for millions of dollars a month, because their coverage, they have a coverage need and they're able to do that. Now, we have to remember that because it's a tax regulated product, always the amount of insurance, there's a limit. And the company is going to let us know, hey, you're going to make this product. If you make a product, then the IRS is like a red flag for the IRS, and you're like, hey, you're putting a lot of cash value here and you don't have enough debt benefit. It means that you just don't want to pay taxes. So the debt benefit has to be kind of aligned with the cash value. You don't have to know all those calculations because the system does it for you, and it gives you the right amount of debt benefit for the cash value that you need. Yes. So let me go over, and we'll go over that on September 19th. So what happens when you make a policy, it means that you exceeded the amount of cash accumulation that you can put into the policy for not to pay taxes, because it means that you're not having enough debt benefit. So the purpose of this policy, it's not for life insurance anymore. It's for avoiding taxes and cash accumulation, because they know that. Now, this MEC thing and regulation, it came out probably 15 years ago, because back in the 90s, you were able to put a lot of money in these policies and they wouldn't, and you could have 25,000 debt benefit and all these cash accumulation, and they were not making, because the IRS kind of was not aware. And then they found out and they're like, hey, wait a second, what's going on, right? Affluent people starting doing these strategies. Now, if you had a policy from back in the 90s, you're good, right? You don't have to worry about that. But they had to change all this with all these new rules and regulations. And once we do an illustration, when we're on training, I'll show you how in the illustration it says MEC, and it's a 7-year level guide premium and all that information, so you'll know. So that's why when the client is like, hey, I want to put this amount more into my policy. Okay, let me check if that's feasible. And if it's gonna increase, if it's gonna make your policy, maybe we need to increase your death benefit. That's why we have to do the yearly reviews always, all the time. Okay, Vanessa says there's a lot of questions, but the main one is, where can I find this recording to revise it? I'm uploading all the videos on YouTube. Now, hopefully my internet's not that bad where I'm at right now, and I'm gonna be able to upload it tonight so you can have it, because you are gonna need to review it. Yes, and then we'll go over this again on September 19th. I just wanted to give you some information so you can start digesting everything, okay? Perfect. Okay, well, I went over 17 minutes. I'm so sorry. You had a question, Anna? Yes.
No, I was just gonna say I missed the